Today, we're going to break down the basics of mortgages in a way that's easy to understand. At its core, a mortgage is a loan you take out to buy a home. You start by making a down payment, which is part of the home's purchase price that you pay up front. Then you borrow the remaining amount needed to buy the house, and you agree to repay that loan over time with added interest. Seeing how these parts fit together in one clear system can make the whole process feel a lot simpler and more manageable. This overview will help you understand exactly how a mortgage works from the initial payment all the way through those monthly bills. A mortgage is essentially a loan specifically designed for purchasing a home. The key thing to understand here is that the home itself acts as collateral for the loan. So, when you borrow money from a lender to buy your house, you agree to pay that amount back over time, usually in monthly installments that include interest. The interest is the cost of borrowing that money. If for some reason a loan isn't repaid, the lender has the legal right to take ownership of property, which is a process called foreclosure. This setup helps protect the lender while allowing you to buy a home even if you don't have all the money up front. When we talk about mortgages in simple terms, it's essentially a long-term loan that allows you to buy a home right now without having to pay the full price up front. You put down a portion of the cost yourself, and your lender covers the rest. Over time, you repay this loan along with interest. The important thing to remember is that the home itself acts as collateral for the loan. So, the core idea here is straightforward. You get to move into your house today and pay for it gradually over time. This makes homeownership more accessible by spreading out the payments instead of requiring a lump sum. Let's talk about the key players involved in a mortgage transaction. First, we have the borrower, who is the buyer applying for the loan and responsible for repaying it over time. Then, there's a lender, which is usually a bank or mortgage company providing the necessary funds for the purchase. The real estate agent plays a crucial role by helping to negotiate the deal and guide the buyer through the home buying process. Lastly, the appraiser is an expert who estimates the market value of the home to ensure the lender that the property is worth the loan amount. These four roles work together to verify the money, the property, its value, and all the transaction details, which is why a mortgage functions smoothly. Understanding these key players helps make the process clearer and less overwhelming. When it comes to mortgage fundamentals, understanding how much you can borrow is key. Lenders look closely at three core inputs to determine this: your income, your credit score, and your down payment. First, your income is compared against your existing debts to estimate how much you can comfortably afford to pay each month. Then, your credit score plays a huge role. A stronger score means you're seen as less risky, which not only improves your chances of approval, but can also increase the amount you're eligible to borrow. Lastly, the down payment matters a lot. The more you can put down up front, the smaller your loan will be, which can help you qualify for a better home or more favorable terms. Ultimately, your borrowing power is a balance between these three factors: your earnings, your financial risk as shown by your credit, and the cash you have available at the start. When we talk about down payments and mortgages, it's really about the initial cash you put into the purchase. Typically, a common target is between 10 to 20%. This range tends to balance what's affordable for most people while also giving you stronger loan terms. Some loans allow down payments as low as 3 to 5%, which can make it easier to buy a home with less upfront cash. However, this usually means you have a higher loan balance and potentially higher monthly payments. On the other hand, putting down 20% or more means you start with more equity in your home, and this often translates into smaller monthly payments. Overall, higher down payments reduce the amount you need to borrow, which can lower your total borrowing costs over time. So, deciding on your down payment amount is about considering your budget, the loan type, and how much you want to finance. Let's walk through the 5 key steps in the mortgage application process. First, we start with pre-qualification. This is a quick estimate of how much you might be able to borrow based on your basic financial details. It's a helpful initial guide, but not a guarantee. Next comes the application stage, where you formally submit detailed information about your income, assets, debts, employment, and the property you're interested in. This step gathers all the necessary data required for evaluation. Then, during processing, the lender organizes your documents, checks for any missing pieces, and prepares everything for further review. After that, we have the appraisal. An independent appraiser evaluates the property to determine its market value, ensuring the lender knows the true collateral value of the home. Finally, the underwriting step is where the lender makes the crucial risk decision. They review all the information and either approve, suspend, or deny the loan. These 5 stages move your file from a simple estimate to a solid lender decision, making the process structured and transparent rather than mysterious. When a lender is considering your mortgage application, they look at several key factors to decide if you qualify. First is your credit history. Your credit score and past payment behavior give them an idea of the risk involved in lending to you. If you have high debt balances or a history of late payments, this can negatively impact both your approval chances and the interest rate you receive. Next is income verification. Lenders want to see documents like pay stubs, W-2 forms, tax returns, and bank records to confirm you have the ability to repay the loan. They compare your income against your existing debts to determine if you can afford the mortgage payments comfortably. Finally, there's a property appraisal. An independent appraiser estimates the market value of the home you're buying. If the appraisal comes in lower than expected, the lender might reduce the loan amount to align with the home's actual worth. In short, lenders investigate your finances thoroughly, verify your income, and confirm that the property supports the loan value before approving your mortgage. This helps ensure that both you and the lender are protected throughout the loan process. Now, let's talk about closing the deal, which is the final step in the mortgage process. This is when the loan truly becomes real and official. First, you'll sign all the necessary documents, finalizing your agreement with the lender. Next, you'll pay the closing costs, which include various fees associated with processing the loan and transferring ownership. Finally, once everything is signed and paid, you receive the keys to your new home, marking the moment the ownership is officially transferred to you. This step is crucial because it makes everything final and puts you in full control of your property. Here we have a breakdown of a sample monthly mortgage payment totaling $2,400. This payment is made up of 4 key components, commonly referred to as PITI: principal, interest, taxes, and insurance. The largest portion, 35% or $840, goes toward the principal, which is the amount you borrowed and are paying down over time. Next, 31% of the payment, or $744, covers the interest, which is essentially the cost of borrowing the money. Taxes account for 20% or $480, and this covers property taxes collected by your local government. Lastly, insurance makes up 14% or $336, which protects your home and lender against potential risks. All of these components together make up your total monthly mortgage payment. Understanding this breakdown helps clarify where your money goes each month. Let's take a closer look at how mortgage payments are composed over a 30-year period. In the early years of the loan, most of your monthly payment goes toward paying interest, which is why the interest portion dominates at the beginning. As time goes on and the loan balance decreases, the interest portion gradually falls. This means that more of your payment starts going toward reducing the principal, the actual amount you borrowed. By the later years, the majority of your payment is applied to the principal, helping you build equity faster. It's important to note that while your monthly payment stays the same throughout the loan term, the mix between principal and interest changes significantly over time. This is a fundamental concept in amortization and is key to understanding how your mortgage works. Let's talk about the 2 main types of mortgages: fixed rate and adjustable rate. A fixed rate mortgage offers payment certainty because your interest rate stays the same for the entire life of the loan. This means your monthly payments are stable and predictable, making it much easier to budget for the long term. It's particularly beneficial if you plan to stay in your home for many years, since market rate spikes won't affect your payments. On the other hand, an adjustable rate mortgage, or ARM, usually starts with a lower interest rate that is fixed for an initial period. After that, the rate adjusts at scheduled intervals based on market conditions. This can mean lower payments early on, which helps if you want to reduce your monthly costs or if you expect to move or refinance before the rate adjusts. However, this also comes with more uncertainty since your payments can increase once the initial fixed period ends. So, if you want stability and plans stay put, a fixed rate mortgage is likely the better choice. But if you expect changes in your housing situation and want lower initial payments, an adjustable rate mortgage might be worth considering. Let's talk about the 5 primary drivers that influence mortgage interest rates. First, your credit score plays a significant role. Generally, higher scores lead to better pricing because they indicate lower risk to lenders. Next is the down payment size. Putting more equity into property can reduce the lender's risk, which can help you secure a better rate. The loan term is also important. 15-year and 30-year loans are priced differently since the repayment timeline affects the lender's exposure. Market conditions impact rates as well. Things like treasury yield, inflation, and demand all cause rates to fluctuate. Lastly, the type of loan you choose, whether conventional, FHA, VA, or jumbo, also affects your rate since each has different guidelines and risk profiles. In essence, interest rates are priced based on risk, shaped by your financial strength, the loan structure, and the market conditions on the day you lock in your rate. Understanding these factors can help you make informed decisions when securing a mortgage. When you take out a 30-year fixed mortgage, each monthly payment covers both interest and principal, but the way they contribute changes over time. In the beginning, most of your payment goes toward interest because it's calculated based on the full loan balance, which is highest at the start. As the loan balance decreases, the interest portion shrinks and more of your payment starts going toward the principal. Here, you can see sample amortization snapshots for a $400,000 loan at 6.5% interest. Notice that in month 1, the interest portion is much larger than the principal. By month 60, although payments remain the same, the principal portion has increased and interest is lower. Fast forward to month 300 and month 360, and you can see that the majority of the payment is now going towards reducing the principal, meaning you're building equity much faster. This gradual shift in how your payment gets applied, same monthly payment but different math, illustrates how equity in your home builds slowly at first, then accelerates as your loan nears payoff. Understanding this journey is key to grasping mortgage fundamentals and how your balance and equity evolve over time. All right, let's talk about what happens on closing day, the big moment when everything comes together. First, there's a final walkthrough. This is your last chance to make sure the property is in the condition you agreed upon, with any repairs completed. Next, you'll review all the important documents. It's crucial to take your time here to understand everything before signing. Then comes the signing of the papers, where you officially agree to the terms and legalize the transaction. After that, you'll pay the closing costs, which cover various fees and expenses associated with the sale. Once all these steps are completed, ownership becomes official, and the property is yours. It's a lot at once, but each step is essential to making your home purchase final. Closing costs are the additional fees you need to pay up front when your loan closes. These costs can vary widely depending on your lender, the state you're in, and the price of the home, but there are some typical fees that most buyers should expect. For example, an appraisal usually costs between $400 and $700, while a home inspection commonly runs from $300 to $600. Title insurance generally falls in the range of 0.5% to 1% of the loan amount. Attorney fees can range from $500 to $1,500, and loan origination fees also typically range from 0.5% to 1%. While this list isn't exhaustive, these are some of the main expenses to consider. Overall, closing costs tend to total around 2 to 5% of your loan amount, so it's important to factor these into your budget when preparing to buy a home. Let's walk through the 3 key steps of how mortgage pre-approval works. First, you submit your financial information. This includes sharing your income, debts, assets, employment details, and granting permission for a credit check. This helps the lender get a clear picture of your financial situation. Next, the lender reviews your information carefully. They evaluate the risk involved, verify the numbers you provided, and estimate the loan amount you're likely to qualify for. Finally, you receive a pre-approval letter. This letter outlines a likely borrowing limit, although it's subject to final underwriting once you actually apply for the loan. Keep in mind, this pre-approval is typically valid for a limited time. Overall, pre-approval is an early lender assessment that gives you a price range before you start house hunting. It shows sellers that you're a serious buyer and can help guide your search effectively. Here are 4 key mortgage terms that you'll encounter frequently throughout the home buying process. First, escrow. This is an account where money is held for property taxes and homeowners insurance until those bills need to be paid. Next is PMI or private mortgage insurance, which protects the lender if your down payment is less than 20%. Then we have appraisal, which is a professional estimate of your home's market value to make sure the price supports the loan amount. Lastly, the title refers to the legal record that shows who owns the property and if there are any claims or liens on it. Understanding these terms will make navigating the paperwork much easier. Let's talk about private mortgage insurance, or PMI. PMI is a type of insurance that protects the lender, not you, when your down payment is less than 20% of the home's value. This means if you put down less than 20%, you'll likely have to pay PMI as an additional monthly cost. The typical cost of PMI ranges from about 0.3 to 1.5% of your original loan amount each year. This percentage is added to your monthly mortgage payments, so it's important to factor it into your budget. PMI usually ends once your loan balance drops to 80% of your home's value. That means after you've built enough equity in your home, you can request to have PMI removed or it will automatically end. Understanding these key points helps you see how PMI impact your mortgage costs and when you can expect it to end. Here we're comparing the key differences between a 15-year and a 30-year loan term, assuming the same loan amount. Starting with monthly payments. A 15-year loan means higher monthly payments because you're repaying the loan in half the time. However, with that higher payment, more of your money goes toward the principal each month, helping you build equity faster. On the other hand, a 30-year loan offers lower monthly payments, which can make managing your cash flow easier. But the trade-off is that you'll be paying interest for twice as long, which significantly increases the total amount of interest you pay over the life of the loan. In terms of total interest paid, the 15-year loan saves you a substantial amount because the loan is paid off faster and there's less time for interest to accrue. Meanwhile, the 30-year loan ends up costing you much more in interest due to the longer repayment period. Finally, when it comes to time to own your home outright, the 15-year loan gets you to full ownership much quicker, while the 30-year loan means a longer term before the home is fully paid off. Simply put, the mortgage fundamentals boil down to this. Shorter terms mean higher monthly payments but lower lifetime costs, and longer terms mean easier monthly payments but much more paid in interest overall. It's all about choosing whether to pay more now or pay more interest later. Refinancing your mortgage can be a smart financial move when the potential savings outweigh the fees involved. Essentially, refinancing means replacing your current mortgage with a new one. Homeowners typically do this to reduce their monthly payments, pay off the loan faster, or access the equity in their home for major expenses. One of the main reasons to refinance is to secure a lower interest rate. This can significantly reduce both your monthly payment and the total amount you pay over the life of the loan. Another option is to refinance to a shorter term, such as moving from a 30-year mortgage to a 15-year mortgage. This allows you to build equity in your home more quickly by paying off the loan faster. Finally, refinancing can offer a cash-out option. With this, you can borrow against the equity in your home, using the funds for renovations, paying off other debts, or tackling other financial needs. The key is to make sure that refinancing truly makes financial sense for your specific situation. Your credit score plays a crucial role in determining the interest rate you'll receive on a mortgage. Lenders use this score to assess risk. So if your score is lower, you might be charged higher rates to compensate for the increased likelihood of default. On the other hand, a higher credit score shows stronger creditworthiness, unlocking better pricing, and reducing your monthly payments. For example, scores in the poor range, between 300 and 619, often come with rate increases of up to 0.85% above the average. Fair and good scores, falling between 620 and 739, tend to have smaller increases or rates near the average. Those with excellent credit, ranging from 740 to 850, can enjoy rates that are actually below the average, sometimes about 0.25% lower. Even a small difference in interest rates can significantly impact the total amount you pay over the life of your mortgage, potentially adding up to thousands of dollars. So, Understanding your credit score and how it affects your mortgage pricing is essential to making smart financial decisions. Here, we're looking at the journey you take when buying a home, which we call your path to home ownership. It starts with preparation, where you get everything in order and make sure you're ready financially and mentally. Next is the application phase, where you officially apply for the mortgage. Once approved, you move to the closing stage, where all the paperwork is finalized and you officially take ownership of the home. Finally, you enter the owning phase, where you save, qualify, close, and repay over time, moving step by step from planning all the way to having a home that truly belongs to you. Each stage is an important milestone on the path to achieving your dream of homeownership. When navigating mortgage offers, it's crucial to watch out for red flags that could signal predatory lending practices. First, avoid loans with excessive interest rates, abusive terms, or those that simply don't fit your financial situation. Transparency is key, so be cautious of hidden fees. Every charge should be clearly disclosed before you close, not sprung on you at the last minute. Also, beware of any pressure to sign quickly. A trustworthy lender will patiently answer your questions and give you ample time to review all the details. And if a rate sounds too good to be true, it probably is. Ultra low quotes might come with hidden costs like points, short lock periods, or potential payment shocks down the line. Remember, not every loan offer is a good one. If something feels rushed or unclear, the best approach is to pause and reassess before moving forward. When you're talking to a lender, it's crucial to ask these 5 key questions every time to make sure you fully understand your loan before you commit. First, ask about the APR or annual percentage rate, which gives you the true cost of the loan, including interest and fees. Next, make sure to find out all the closing costs involved, so there are no surprises at the end. Third, ask if there are any prepayment penalties, because you want to know if paying off your loan early will cost you extra. Fourth, see if you can lock in your interest rate, which protects you from rate increases while your loan is being processed. And finally, ask about the monthly payments to understand exactly what you'll owe each month. These questions are important because they uncover the real cost of borrowing and help you make an informed decision. Always bring these questions into every conversation with your lender. When evaluating a mortgage, there are 4 key ideas you need to keep in mind. First, a mortgage is a long-term commitment. It's important to recognize that you're entering into a financial obligation that can last 15, 20, or even 30 years. Second, you should understand how your payment breaks down each month, including principal, interest, taxes, and insurance. Third, it's crucial to shop around and compare interest rates to get the best deal possible. And finally, don't forget to plan for closing costs, which can add up and affect your overall budget. The bottom line is that smart borrowers look beyond just the price of the house. They prepare for the full cost of the loan to avoid surprises down the road. Keeping these points in mind will help you make a well-informed decision when choosing a mortgage. Now that we've covered the essentials, it's time to focus on getting started with home ownership. The first step is to talk to a lender. This helps you understand your budget and what you can realistically afford. It's important to review your income, savings, credit, and different loan options at this stage. Once you have a clear picture, getting pre-approved is crucial. Pre-approval not only tells you your price range, but also gives you a stronger offer when you find the right home. The ultimate goal here is to shop for your new home with confidence and clarity, rather than making decisions based on guesswork. Taking these steps will set you up for a successful mortgage journey and a smoother path to owning your home.